This week, the stock market just got wrecked. Trillions of dollars were wiped out in a matter of just days. If you opened up your 401k and you felt your stomach drop, yeah, you're not alone. And the cause? A set of sweeping tariffs announced by President Trump, part of what he called Liberation Day. But if you're an investor, it felt like more of a hostage situation. Today, we're going to break down what happened, why it happened, and what you should actually do right now if your portfolio is in free fall. Now, let's rewind. On April 2nd, President Trump made a surprise announcement, effective immediately. The US would impose a 10% universal tariff on all imports, but it didn't just stop there. Countries like China got hit with a 34% tariff, Vietnam, 46%, Japan, 24%, the European Union, 20%. Only Canada and Mexico were spared, and Trump framed it as a patriotic move. He posted on Truth Social saying, "It's time to take our economy back. We don't need China, and we don't need cheap junk. We just need jobs in America." He dubbed the day Liberation Day and said Americans needed to hang tough while we fight for economic independence. Now here's the thing, tariffs aren't new. Trump used them during his first term too, if you remember back to the Chinese trade war in 2018, but this time it's bigger, it's broader, and it dropped with no warning, and markets just hate that. Within hours, stock futures plunged. On April 3rd, the S&P 500 tanked 6%. The Dow dropped over 2,200 points, which is one of the worst single-day losses since the early days of the pandemic. The Nasdaq lost 6%. Tech stocks got crushed. Apple fell 9%. Nvidia dropped double digits. Retailers like Nike and Target dropped on fears of rising import costs. Industrial giants like Caterpillar and John Deere sold off as supply chain worries started to mount. And this wasn't just a Wall Street thing. Millions of Americans saw their retirement accounts take massive hits. The average 401k lost nearly $8,000 in value in just 48 hours. IRAs, college saving plans, pension funds, all took a beating. Even conservative index fund investors weren't spared. The damage was fast, and it was everywhere. By week's end, the Nasdaq was down almost 20% year to date. The Russell 2000, a key gauge of small cap companies, dropped over 18%. Investors who had been riding the AI and soft landing rallies suddenly realized that the floor had dropped out from under them. But the tariffs didn't just hit stocks, they rattled the entire global economy. China responded quickly with its own tariffs, 34% on all US goods. The EU and Japan issued statements warning of further retaliation. Vietnam hinted at a strategic reevaluation of its US trade relationships, and behind the scenes, supply chain managers are scrambling. Goods stuck at ports. Prices expected to rise. Contracts are being reworked. The Federal Reserve wasn't ready for this. Chair Jerome Powell said that the Fed had not anticipated a full-blown trade war in this outlook and warned that inflation could reaccelerate if import prices were to spike. At the same time, he noted that tariffs would likely slow down demand and reduce GDP. And here's where it gets dangerous. When prices go up and growth slows, you risk stagflation. It happened in the 70s under Nixon, and it's one of the scenarios that's hardest for the Fed to fix. We're already seeing signs of that inflation creep. Grocery chains are bracing for higher produce and packaged food costs. Electronics, which rely heavily on Asian imports, are expected to rise in price by 10 to 15% by summer. Car prices, which had finally started cooling, are now reversing course as auto parts become more expensive. And with oil still trading near $85 a barrel, higher transportation costs could push everything up even more. Now let's talk numbers. The Atlanta Fed's GDP Now tracker has already revised Q2 growth down to 1.2%, and that's from 2.9% just a few weeks ago. Axios and the Wall Street Journal both reported rising odds of a recession. Some economists now peg the chance at 60%. Companies are starting to freeze hiring. Earnings estimates are being revised down, and investor sentiment is collapsing. The VIX, which is Wall Street's fear and greed index, surged past 30, a level we haven't seen in a while. So how did all of this unfold so fast? Now, part of this is algorithmic trading. Once the initial tariff news broke, sell signals were triggered across the board. Momentum traders dumped stocks. Risk models adjusted. Margin calls got triggered. And that's how you go from a 2% dip to a 6% crash in one session. It's not just fear, it's math. The machines made it worse, but there's also a psychological side here. Behavioral finance teaches us that investors fear losses more than they value gains. It's called loss aversion. And once panic sets in, people follow the herd. They sell not because they want to, but because they're scared other people already did. And let's be honest, the media just doesn't help at all. Financial news, we're running red tickers and market crash headlines nonstop. Twitter, Reddit, cable news, it all adds fuel to the fire. I think Fox even took the tickers off the bottom of the page. Doom scrolling kicks in, people start comparing this to 2008, and even the fundamentals are very different. This emotional spiral is exactly what causes overreactions. Some analysts are saying this drop may have been coming anyway. After all, valuations were quite stretched. The S&P was trading at nearly 23 times earnings, which is historically high. There was also talk of a bubble forming in AI stocks. The tariff shock might have just been the pin that popped the balloon. So, what are people doing now? Former Goldman Sachs CEO Lloyd Blankfein urged Trump to walk it back, or at least delay the harsher tariffs for 6 months. He argued that the 10% blanket tariff could be used as leverage for better deals, but going all in on day one was completely reckless. So far, Trump hasn't responded. His base is rallying behind him, saying that this is what America needs, this is what they voted for, but even within the GOP, there's growing concerns about the economic fallout. Some in Congress are calling for emergency hearings. There's chatter about legislation to block unilateral tariff powers and make it up to Congress to impose tariffs and not the president. And yes, the World Trade Organization is reviewing complaints already filed by affected countries. All of this is happening in a tense geopolitical climate. Relations with China were already icy. The Taiwan Strait remains a flashpoint. The Middle East is still volatile, and any disruptions in global trade, especially energy or semiconductors, could make things worse. This isn't just an economic risk, it's a geopolitical one too. Okay, so now the part you're probably waiting for. What should you actually do about this? First, don't panic. Stay calm. Seriously. If you sold during the pandemic crash or 2008 or 2001, you probably regret it. Markets go down fast and they come back slowly, but they do come back and they reach new all-time highs. History is filled with crashes that eventually recover. The worst thing you could do is lock in your losses by selling emotionally. Now, that doesn't mean ignore it completely. This is the time to reassess your portfolio. Are you too concentrated in tech, all in on growth stocks with no earnings? If so, it might be time to rebalance. Look at value stocks, dividend players, sectors like utilities and healthcare that hold up better in downturns because you can't just get rid of your utilities. Make sure your emergency fund is solid, especially if you're near retirement. You don't want to be forced to sell stocks at a loss to cover your bills. And if you're younger, this might be a buying opportunity, but that doesn't mean YOLOing on options or meme stocks or poop coin. Stay diversified. Think long-term, dollar cost average if you're unsure. You can also take steps outside the market. If you think a recession's coming, and let's be honest, it might be, now's the time to cut unnecessary spending, build a cash buffer, and maybe even pick up some new skills. Having a second income stream never hurts, especially when the job market might tighten. And finally, understand this. These shocks, they come and go. Politicians change, policies change, but wealth is built by staying disciplined when others are panicked. Be greedy when others are fearful. The people who win long-term are not the ones who time the market perfectly. They're the ones who don't get shaken out during the chaos. So, where do we go from here? Best case, Trump scales back the tariffs, negotiations open up, and the markets recover. Worst case is global trade slowing, inflation rising, and we slide into full-blown recession. Most likely, somewhere in between. Much of the world's already in recession, so we'll probably head there anyway, but hopefully it's mild. Now, whatever happens, keep your head, stay informed, and don't trade on your emotions. If this video helped you at all, hit the like button, subscribe, and leave a comment down below. Are you buying the dip, holding steady, or sitting on cash? Thank you so much for watching. I'll see you next time.